What is going on, my future meta millionaires? It is your boy Terry Stonkers, and welcome to the channel, baby. By the dip. All right, guys. Today we are going to focus on two videos that we're going to watch. These videos, we're going to have a little reaction to the videos, and we're going to be talking about oil. Yes, how the oil is going to be pretty exciting going forward. I think it's going to help seal the deal for our dividend and Oro Grande Basin. And super excited about that, man. So we're going to cover these videos. Hope you are ready for today's video. If you are, smash thumbs up. Leave a comment down below. It helps out the algorithm. So, baby, let's go. All right, and if you're not following me on Twitter, go follow me on Twitter at TerryZ247. We have over 1,700 followers now, and we are growing. All right, guys, the first one I want to watch here is the one I posted just a couple minutes ago, where oil is going to be priced to go to $105 by Goldman Sachs. So let's get
oil
this video up here.
A 7-year high on Tuesday, trading in the mid $80 range, actually above $85 and even higher. Joining us right now with his outlook on where prices are headed is Jeff Currie. He's global head of commodity research at Goldman Sachs. Hey, Jeff, early this morning, Richard Engel was on from NBC talking about just the heightened tensions right now between Russia, the United States, the Ukraine, and everything that's happening with NATO.
As you can see here on this chart, guys, oil hit 7-year high. Like I said, that's fantastic news. We got this gentleman here from Goldman Sachs saying he has a price target of $105. He does say in his interview, we're going to see where he covers that $105 for the second half of 2022. So let's keep going.
This is a serious point of inflection. This is something that really matters right now. And maybe we don't talk about it enough, but it certainly looks like it's getting picked up on when it comes to the global markets, especially in the price of oil.
Well, when we look at the movement in the last couple of days, I want to emphasize that it's driven by fundamentals, not the geopolitical risks. Now, the market is much more vulnerable today to these geopolitical risks than ever before, at least in this cycle, because inventories are so low. So the very tight fundamentals makes the market more exposed to these events. But at this point right now, these geopolitical events really haven't led to any substantial disruptions in supplies of oil around the world. And I think it's important to emphasize that a lot of the risks that created that big pullback on Black Friday back in November of last year have all turned out not to have an impact on demand, whether it was Omicron, the SBR, or even OPEC. Bottom line, fundamentals continue to decline. Demand remains strong. The IEA flip-flopped on their weak demand forecast and put out a much more bullish outlook on demand right now, which underscores just how tight this market is. So I want to point out this market is fundamentally tight. Demand is above supply still. We don't have adequate supplies to cover this demand growth. That's what creates this upside risk. Our target by the second half of this year is over 100 at 105.
So there you go. There's where he says it. Their target for the second half of this year of 2022 is $105. They're talking about there is so much demand right now for the oil that they can't even keep up with it. So if we have this land for sale, whether we do the divvy or the spinoff, it's going to put our assets in really high demand. People's going to want that. We have projected 3.2 billion barrels of oil at our Torchlight land. So like I said, our stuff's going to be highly sought after. Whether NextBridge is going to be the one spinning this out, we will have to see. Let's continue on here.
In terms of fixing the supply picture, could OPEC and Russia fix it somewhat if they wanted to, or do they like prices where they are?
You look at the world right now, there are only two producers who can produce more today than what they could in January of 2020 before COVID struck. And the answer to that is UAE and Saudi Arabia. Russia struggles to even hit their OPEC plus quotas right now, which underscores the lack of investment to grow supplies. The U.S. is nearly 1.8 million barrels per day below those January 2020 levels. So it indicates is that OPEC, Russia, outside of a select few producers, do not have the capacity to be able to meet these higher demand levels, which is why inventories are likely to draw to critical operating levels during first quarter and create a lot of upside price risk. That's why our price targets, our forecasts are now well above 100 or at 105, which underscores the risk here.
105 for this quarter or for this year?
Look at that chart. The 1 year chart, it's up over 62.5%, guys.
Sure.
We're 96 for this year, 105 next year, and we expect it to breach 100, as you enter, that July, August time period. But I want to emphasize the risk right now are very much skewed to the upside, given the fact that, you don't have a lot of investors in this market, which means you could get, financial flows moving into this market on top of relatively tight fundamentals. And that's an important point, is that investors, for the most part, have shunned this space. It's, look at the market cap. It's running somewhere around, 5%, the energy sector. But overall, the earnings are running.
We can definitely tell you that we investors are in it with MMTLP and our Torchlight Series A preferred shares. So as you said, by July, they are predicting $100. Now, as we talked about before, that just builds the case. That builds up our demand and our supply that we have. That makes the big oil companies want to look at our property and whether they purchase it, or if it's next bridge, maybe they decide to keep it private and just sell out to, however they want to do it. I don't know. But this is just exciting to hear, someone from Goldman Sachs giving a $100 price target by July.
Around 5%, but the market cap is somewhere around 3%, which tells you, investors' interest in this space is very weak.
All right, so there's that one,
hitting
guys.
a 7-year.
Now we got one down here from Dan K. Eberhardt. He was on Fox Business today. I just retweeted this one as well. And it says here, drivers should expect no relief at the pump in the near term due to spiking crude oil prices that are filtering into cost of refined products like gasoline, diesel, and jet fuel. Check out my conversation with Fox Business. So here you can see, earlier today it was over $87. Let's go watch this interview.
So as the pain at the pump shows no sign of slowing, progressives like Alexandria Ocasio-Cortez and her squad are trying to place the blame on the business guys, the people who actually pump the oil. Canary CEO Dan Eberhardt joins us now. Dan, this is rich. After trying everything they could possibly do to make it harder and more expensive to pump oil, they're blaming the guys who do pump the oil for the rising prices.
Yeah, look, the Biden administration is talking out of both sides of their mouth. Look, we're getting the government we voted for, getting the government we deserve in terms of Biden, canceled Keystone Pipeline, stopped drilling on federal lands, stopped offshore or fracking on federal lands, stopped auctioning off offshore blocks. All of these things and other kind of more minutia have.
Look at this chart here, guys. Up 15.8% in this last month, crude oil. That's truly amazing for us. We are probably a small pool of investors that are happy to see oil prices go up. Now I know we hate to see if you have oil gas, if your gas bill goes up. We hate to see gasoline for the cars go up. But in return, it can pay out big for our dividend. Like I said, it just keeps building our case stronger with the dividend, and that's why I wanted to bring you these interviews. So let's continue on here to Dan's interview.
Have made it harder for us to be in the oil and gas business, harder for us to generate supply, which is pushing the price up. Look, we're a business like any other, and this blame shifting where they're trying to, make the meat producing companies, the oil producing companies are out to gouge consumers. That's not what's happening at all. Oil is a worldwide product, a worldwide situation, and Biden is just making the supply less, and it's hurting consumers at the pump. And it's making it harder for us in the oil and gas industry, not easier.
Now, Biden was the first person that I heard use the phrase price gouging in speaking about the oil companies when prices began to go through the roof. How is he following through on his rhetoric to make life even more difficult, to make it even more expensive for the people that are pumping oil and providing us with natural gas?
Yeah, look, well, what he's doing is adding regulations, and he's adding.
There you go, guys. Look at this. The chart this month, You got BP up 20%. You got ExxonMobil up 19.7%. You got Chevron up 10.5%. Oil is just going crazy. This is what I'm saying, man. People out here saying a $1 and $3 dividend. I just don't see how. We covered in the live stream last night that George's interview when he said the dividend could be anywhere from $1 to over $20. And George did mention about that Biden administration. He don't know how the Biden administration would affect oil. During that interview, oil was $65 roughly a barrel. Oil now is basically $86, $87 a barrel. We are hearing now, even from Goldman Sachs, that we're probably going to hit $100 this July, guys. It's coming. So I'm going to be very excited to see what happens here with NextBridge. Now we're just speculating that it's NextBridge because the pictures on that NextBridge look exactly like Torchlight pictures. Yeah, but it's super exciting. Let's refresh here. I'm not going to play the whole interview, but you kind of get the gist of what's going on. If you want to watch the whole interview, the 5 minutes, get on my Twitter. You can click on it here and watch it. All right, so let's refresh here on the crude oil. So $86 on the crude oil, and the Brent crude is 87.37. And I'm going to go in here and give you the quick short, well, if it loads up here, short interest. I'm going to give you the Fintel information real quick here, guys, and we'll call it the end of this video. Short squeeze score 75.45. There's 350,000 shares available to short. Short bar fees 1.1%. Wow, they really shorted us again pretty heavy at the FINRA, 58.34%. And the aggregate short volume ratio, we have that information, 63.29. They are heavy in shorting us, guys. Still no update here on the failure to delivers, but the last one that we had was about 360-some thousand. And our short interest percent of float is a 14.79. And we'll take a quick look at the owners. Nothing there. Do we have any new buyers? Cutler Group, that was yesterday. We covered that one. And sellers. Do we have any for the 19th? No. Those are all from those options right there. So, all right, guys. That's going to be it for this video. Like I said, I just wanted to bring you those two interviews. The one of Goldman Sachs and the one there with Dan from Canary Investments. And wanted to bring you, man, Divvy should be looking good. I'm glad, we don't know if it's sold or not sold, but if it's not sold, yeah, super exciting stuff. Win Divvy, because I'm super excited. So hope you all enjoyed today's video. If you did, smash thumbs up, leave a comment down below, and I'll catch you all in the next video. Peace.